morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're talking more results as we head into the festive season of the year, but also covering some financial results from companies as well. And we're talking about two related companies today, Guardian Holdings Limited, as well as NCB Financial Group, or NCBFG. We call them NCB for short. Let's take a look at how both groups would have fared in terms of their stock performance and their financial results and what investors might expect in the coming months ahead. And certainly it was positive reading for the most recently concluded fiscal period. So turning firstly to Guardian Holdings Limited, or GHL, well, the group reported an earnings per share figure of $2.58, which was a very impressive 29% increase from that $2 per share recorded in the prior comparable period of 2023. Now, driving this performance was an improvement in its insurance service result, up 25% from 490 million to just about 613 million. Overall net income from all activities up 8.7% from 1.4 billion to just about $1.55 billion. Operating profits up 18.9%, and ultimately profit attributable to owners of the company up that 29.1% from 463 million odd to just under that $600 million mark. So certainly good reading at the 9-month marker for GHL as we move into the final quarter of its fiscal period. Now, in terms of operating profit by segment contributions across most of its major segments, well, it also made for very good reading, positive developments across all of those segments. The life, health, and pension segment, the largest contributor to operating profit in that pinkish color, up around 16% to 745 odd million in operating profits from 642 million in the prior comparable period. Property and casualty, the second largest contributor, up just around 6% to that $182 million mark from 173 odd million in the prior comparable period. Insurance brokerage also up fairly significantly, although a much smaller contributor to operating profits, up 130 odd percent from that $28 million in that prior comparable period to just over the $65 million mark. And asset management holding firm in what has been a fairly volatile period, with some marginal improvement, up just around 0.5% from 35 million to 35.2 million in that operating profit contribution. But again, positive markers and indicators in terms of improved performance across all of its major operating segments. And that certainly would come as welcome news to investors in this particular environment. Now, taking a look at GHL's book value per share, we can see that its book value per share actually improved over the prior comparable periods after declining a bit, albeit with changing accounting standards. But over the 9-month 2023 to 9-month 2024 period, that book value per share increased from $15.70 to just about $18.58. And what that means for investors in terms of its price to book ratio is that investors are paying pretty much a discount relative to the book value per share to purchase these Guardian Holding shares. And of course, relative to its own historical trading levels, where it was trading at within a range of, let's call it 1.2 to 1.5 times book value, it's now trading at a book value of around 0.73 times, so roughly half of what its book value multiple would have been over the past few comparable periods. So certainly there does appear to be some value on offer for GHL investors when looking at the stock from a book value per share perspective. So at that price of $13.60 per share, GHL is trading at a price to earnings ratio of 3.8 times, which is considerably below the sector average of 10.3 times, with a fairly generous dividend yield of 5.6%. A little bit below the sector average of 6.3%, but that may have been skewed by some other fairly extraordinary type dividend payments by some other constituents of this particular sector. So with revenue growth in mind, those are attractive valuations and certainly an appealing dividend yield, Bourse is upgrading its rating on GHL to an overweight for the time being. Turning quickly to NCBFG, well, the group would have reported at the parent company of GHL, of course, the group would have reported an earnings per share figure of 27 cents TT equivalent for its fiscal year ended September 2024, compared to that 6 cents per share recorded in the prior comparable period. That is a 355% odd percent increase. Net revenues from banking and investment activities up 2.1% from 5.04 billion TT equivalent to just about 5.14 billion TT equivalent. Ultimately, profit attributable to equity holders up that 356 odd percent from 139, just under 140 million TT equivalent mark to over 638 million. Now, when we take a look at NCB's operating profit by activity, a much more mixed view when compared to Guardian Holdings Limited, for example. However, the LH&P segment, or life, health, and insurance pension fund management segment, up around 34% from 759 million TT equivalent in that prior fiscal year to just over $1 billion TT equivalent. Treasury and correspondent banking, also a fairly positive spot. Excuse me, up from 420 million TT equivalent to just about 550 odd million TT equivalent as well. Now, similar to GHL, NCBFG is trading at a fairly generous discount in terms of its price to book ratio at around 0.8 times compared to its historical levels, which were closer to 2.9 to 3 times in the post-COVID or immediately post-COVID period or during COVID period rather. And that price to book ratio has steadily trended down. However, its book value per share has increased significantly from $2.46 at its year-end in fiscal 2023 to $2.87 at its most recently concluded fiscal year. And again, that might represent a reasonably attractive value to investors. So at a price of $2.25 per share, NCB is trading at that price-earnings ratio of 8.4 times, which is below the sector average for the banking sector of 10.2 times, with a dividend yield of 3.8%, which is on its own is a reasonably generous dividend yield. Of course, a little bit below the sector average of 4.7%. But with those higher banking revenues in mind, that improved insurance result, the resumption of what we believe will be more consistent dividend payments and attractive multiples across both the price earnings, a reasonable dividend yield, and of course that attractive price to book multiple, Bourse is maintaining its overweight rating on NCB for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free at bourseinvestment.com. And of course, you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.